Welcome back to another episode of Investing Explained. Here's today's question. Let's talk about the scenario that you put up here, considering an economy with a 0% inflation. The government would be selling long-term bonds for, say, $1,000 to the private sector. And to attract people, the government would have to offer an interest rate, say 1% a year. The government would then have to pay the full amount back of the bond, which is $1,000, plus the annual interest payment of these bonds, which would be an additional $10. So in this scenario, with a 0% inflation, the investor would collect $10 in profit and thereby also increase his purchasing power. Going back to what you said there, what if we include inflation into the equation? What if the government ensured a higher inflation? Now, so let's consider the situation where inflation was 10%. So that would be to the disadvantage of the investor, who normally would be able to buy for $10 more, but the goods and services he could buy for $1,000 before inflation, that would now be priced at $1,100 because you had that 10% inflation. So in that case, with a higher inflation, that would be advantageous for the government. And the reason for that is that because of the inflation, the government will get higher tax revenues as wages and prices increase too. It would be roughly 10%. So they would gain 9% and the investor would lose 9%. So in theory, this seems to be a perfect solution, at least for the government, right? And we've seen this implemented in the UK after the Second World War, and we also saw that happening in the US in the 1970s. There is, however, a lot of negative effects to this, if that is the route you want to pursue. First of all, if investors expect this to happen, they will require a higher yield on their bonds, which means higher interest payments. It can also ultimately mean that investors lose trust in the currency and in the government. And for the US, it might mean that they would lose the privilege as being the global reserve currency, which would make a deleveraging extremely painful. And we also see that high inflation has repeatedly throughout history led to social unrest among the population because they do lose trust in the system. And then to your other point about inflation without a currency war, it's really two sides of the same coin. Interest rates are determined by supply and demand. So if you print a lot more money, causing inflation and consciously depreciating your currency by adding a higher supply, it's really hard to have one without the other. And that's what you're seeing playing out right now, and you'll be seeing for quite some time. So your question might then be, and that was not your question, but I'm already started rambling here, but your question might be, so how do we solve it? What's the best way? And the cheeky answer is really not to get there in the first place. Whenever you have a democracy, and I just love this quote by Churchill whenever he referred to it as the worst form of government, except for all the other forms that have been tried. But whenever you have a democracy, you both have the implicit risk and incentive of having people in power or people who want to be in power spending more money or promising to spend more money that they have and then have the next generation pay for it. But really the optimal way would be to deleverage having a higher nominal growth rate than the nominal interest rate you pay. It's hard to do because the more debt you have, the harder it gets for the government to implement that. And there's really no easy answer right now to deleverage at the outrageous level that we're seeing. In theory, it's easy because you can just monetize the debt. But in practice, it is extremely hard because someone or some groups would have to pay for it, which is a political decision, and that makes it really, really difficult.
What a great question, and it fits perfect for the episode that we just recorded. And I think for people that might have listened to the conversation we just had with this all-star cast of folks, it can get a little overwhelming. It can sound like a bunch of just really crazy terminology, and then it just none of it really makes a lot of sense because we're talking about a lot of different concepts and kind of mixing them all together. So I can understand the simplicity in your question, but the answer to it is extremely complex. As you know, Stig found himself as he's there explaining his response to you. It gets really technical really fast. This would be my best attempt of trying to make it as simple as possible. The part that Stig was talking about there at the end, as far as about the people that are elected and how they have to guard against the incentive that they have to vote themselves money into their district, is at the heart of almost all of this. Okay. You have to have elected officials that greatly guard against that tendency and that urge and that incentive structure to do so. Because what happens in the long run is a country becomes further in debt. They can adjust, or they can leverage the power of the currency in their favor, and they can adjust interest rates in their favor to allow that to occur. And then the further that they go down that path of adjusting this, the money, the hard money versus the currency, which is what they're printing and putting into the population, the more that they adjust that, the more it's hard to go back to sound money. And so, from the 1940s up until the 1980s, we had sound money, or at least the population believed we had sound money because we had a gold standard. And then in 71, we came off the gold standard. And then you had interest rates sky high because what we are effectively doing, where we were adjusting what's called the money multiplier. We were adjusting based on how much gold was sitting in reserves, right? Versus how much currency was in the system. They kept adjusting how much reserves had to be sitting there and how much currency was added into the system. They did this since Bretton Woods up until 71, when they were forced to come off the gold standard because they had manipulated the money multiplier so much. When you do that for so many decades, you create a vacuum of interest, of foreign money to flow into this country. And that's why you saw interest rates going sky high, and then you saw them really peaking out into the early 1980s. Well, the only way to then correct that was to then start adjusting interest rates lower and lower and lower. So now we're at this point where interest rates are at zero. We don't have sound money. We don't have anything. It's not backed by anything, right? And you have this tendency of elected officials to spend more than we take in. And I think that when you have those three variables at play, the only way that a country can kind of offset that is through the debasement of the currency. And so who's the entity, who's the party that eventually who's on the losing proposition of that deal? And for me, at least, it's the people that own the debt. If you own bonds, if you own those as an investment, and they continue to print at a pace that outstrips, going back to Stig's example that he provided, his very simple example of $1,000 bond. If inflation's 10% and the thing's only yielding 1%, you just lost 9% of your buying power on an annual basis. And then when you start annualizing that over, like, let's just say it's a 30-year bond, that compounding of a loss in buying power of 9% in that example is very detrimental over the long haul because it becomes exponential. Most people can only think in linear terms because exponentials are very difficult to understand because our daily lives are not in linear term, or they're in very linear terms, not in exponential terms. But when you compound something like that over a decade or more, the impact is dramatic to what it does to society. And that's what, in my opinion, we see playing out. So a lot of what we were discussing in this episode revolves around these fundamental ideas that Stig and I just talked about here at the end of the show. And it can get very nuanced. It can get into, we start talking about UBI versus universal basic income versus QE and how the Fed's inserting the money. And all these things you're talking about a very complex system that can have many different outcomes. But I think the one key driving factor that we're facing today is the incentive structures that used to be favorable are now actually inverting themselves. And you're finding that a lot of the incentive structures that exist right now are not supportive for a conducive economy that works for everybody. It's only working for a few. And that's where it's getting very concerning.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.